The United States debt ceiling has been reached once again, and threats of default are growing. Congress could reach an agreement to raise the ceiling in time. But even if that happens, America's soaring debt continues to pose serious risks not only to our economy, but to the global economy. Economic uncertainty means you have to keep up with what's happening. Make sure you subscribe and we'll keep you in the know. Between 1960 and today, the federal government has reached the debt ceiling 79 times. Right now, the ceiling is stuck at a mind-boggling $31.4 trillion. Democrats in Congress say the debt ceiling should be raised without conditions. Republicans say they'll agree to raise it only if there's an agreement to cut spending. They have until June to solve their differences, says Treasury Secretary Janet Yellen. But if they don't fix it by then, the United States government could default on its debt for the first time in history. Janet Yellen says the consequences of default would be catastrophic. What consequences? Well, Moody's economists get specific, saying the consequences of default could include a decline in real GDP of 4%, an unemployment rate near 10%, and maybe worst of all in my mind, economic volatility that could wipe $15 trillion from household net worth. Moody's also says the economy would be overwhelmed from global investors dumping Treasury securities. Rates would soar. As they do, the rates paid by consumers for homes, cars, credit cards, and other things would also rise. Analysts agree the impact from a debt default would not be confined to our nation. A default would erode the global community's confidence in our financial stability and send shockwaves through the global community. Here's how policy analyst Jacob Kierkegaard puts it. The U.S. Treasury market is the world's anchor asset. If it turns out that asset is not actually risk-free, but that it can actually default, that would basically detonate a bomb in the middle of the global financial system. So volatility would rock global financial markets. Global credit markets would be paralyzed. Worldwide recession would result. A peaceful resolution to the debt ceiling standoff would avoid these dire consequences. But for how long? If we don't default and instead raise the ceiling without spending cuts, it would mean it's full speed ahead, once again, in racking up debt. The Committee for Responsible Federal Budgets says the part of the federal debt that's held by the public could reach 140% of GDP in a short 9 years. It's just one of the reasons the committee has declared the United States faces an unsustainable fiscal outlook. Add to that the opinion of the Congressional Budget Office, or CBO. They say the nation's rapidly growing debt burden eventually could trigger the same crisis conditions as an outright default. Mounting debt could erode investors' confidence in the U.S. government's fiscal position. Such an erosion of confidence would undermine the value of Treasury securities. The CBO says financial institutions that hold those sinking treasuries could fail. The financial crisis would become worldwide in scope. Default or not, remember this. Retirement savers with so much at stake would be well advised to be equally prepared for all the risks, soaring national debt or default. I suggest you take the time to learn more about what's really going on in the economy by attending our exclusive one-on-one web conference at AugustaPreciousMetals.com/webconference.